Good afternoon, and thank you for joining the Future of Finance discussion today on CSDs. I shall now hand you over to Dominic Hobson.
Hello everybody, welcome to our webinar, How CSDs Can Fix the Blue Screen of Death They See in Front of Them. I'm Dominic Hobson, co-founder of Future of Finance, and it's my privilege to moderate our discussion today. Tokenization of assets, security tokens in particular, has the potential to disrupt the securities markets. And on the face of it, central securities depositories are more vulnerable than most. Who needs to issue securities into a depository when security tokens can be issued directly into investors' wallets and a distributed ledger will keep the issues and the holdings in line with each other? Why wait 2 days to settle a transaction in real time between accounts at a CSD when you can settle it atomically without involving a bank or a CSD at all? Why rely on a CSD to maintain a register of investors when the distributed ledger does it for you automatically, updating the register as it goes, transaction by transaction? Who needs a CSD at the beginning and end of these complex chains of corporate actions when you can rely on a smart contract to issue your instruction, collect your entitlements, and vote your stock? Now, if the answer to those questions is yes, all the core functions of a CSD, guarding the integrity of issues, maintaining a register of investors and holdings, settling transactions and servicing assets, are redundant. As Shakespeare put it, Othello's occupation is gone, and so are CSDs. Now, CSDs rose to global prominence in the 1990s as the G30 approved solution to the settlement failures of the 1980s. Are we now saying they're on the brink of extinction after less than 30 years in the limelight? To help us find out, I'm joined by 6 people who've been thinking about the future of CSDs for some time. Alex Powell is Chief Technology Officer at Euroclear UK and Ireland, with experience of CSDs that stretches right back to their origins in the 1990s. Richard Crook set up Lab 577, an independent software company, after 8 years at RBS, where he led efforts to transform the bank using digital technology. John Falk is a partner at Bourse Consult, an independent consultancy that advises financial market infrastructures, and is a former director of securities market infrastructure at Swift. Chris Richardson is CEO at Percival Software, which specializes in technologies for CSDs and other post-trade service providers. Matthew de Heering is Director of Capital Market Strategy at Swift, which is the major supplier of standardized secure international messaging services to CSDs. Last but not least, Roland Chai is Group Chief Risk Officer at NASDAQ, which owns a number of CSDs and, of course, sells technology to CSDs as well. Now, in addition to our panelists, we do, of course, also have you, our audience, and all of us encourage everybody watching or listening to submit questions and comments throughout the webinar by using the Q&A or chat functionality at the bottom of your screens. Rest assured, we won't be saving these questions up to the end, but we'll endeavour to answer them as we go along. There's lots to talk about, so let's begin with the point I raised a moment ago. And I'd like perhaps Richard and Chris to make the case for the disruptors, if you like, before Alex and Roland can come back to us and give us the case perhaps for the incumbents, or at least comment on what Richard and Chris are going to say, which is this. The incumbents in any industry will always say that they exist for a reason, that they fulfill functions that need to be performed, even if those markets are being transformed by digital technology. Indeed, there's no shortage of CSDs saying exactly that now. My question is, should we believe what the CSDs are saying? Is what they're doing so important that it can't be done by anybody else? Or should we agree with those who say that we can possibly do without CSDs? Richard, could I ask you to give us a few thoughts on that to start with?
Yeah, I think the thought that that they don't exist for a reason is one that the regulation shows clearly that they do exist for a reason. We wouldn't have the regulation for no purpose. The CSDs are there to maintain a register of those securities and the investors who own those securities. So the function they perform, the social duty that they perform within the ecosystem, is not in question or in debate. How it's delivered is really what's in debate here, where, as always, when a new technology comes along, it will disrupt a market, just as we moved from a paper-based registry and dematerialized those securities into electronic records, which was only recently done in terms of a timeline, and gained these large centralized databases of these records. when a new technology comes along that actually allows you to distribute that database, decentralize it, there's now a question as to whether we need to maintain that central entity, the legal entity, the company that we have enshrined in the regulation. So we should not, and what we always talk to when we talk to our clients, we should not be fooled by a regulation that has enshrined the existence of a centralized security depository to make us fooled into feeling that they are necessary in that form. As we're watching the regulation change across the world to a more decentralized capability so that we do not provide pricing power to those financial market infrastructure components, we will see the CSDs start to be disrupted.
Thanks, Richard. Chris, you've heard what Richard said. It's not a question of whether what they're doing is worthwhile. It's a question of how it's done. What's your perspective?
I feel a little bit odd arguing here for the disruptors. Quite traitorous, actually, because I have to come out on the side of the incumbents. Okay, the reason there are CSDs, and the CSDs fall into two cultures. First of all, let me say one of those CSDs is name on register, the beneficial owner level CSDs. And you get those in emerging markets. The more northernmost member countries in the EU follow that model as well. Most of the rest of the world use omnibus accounts only. And CSDs really are there to provide settlement capability and a basis for selling more complex products to the participants who are interested in that kind of thing. But the CSDs came into being on the basis of the first G30 recommendations in 1989. I don't think anyone particularly wanted them at that time or understood what they were going to be. But that small group of people said, no, we need to get the paper out of the system, value paper out of the system to make the whole process more efficient. And they've been largely quite successful at that. But to say that the existing users of CSD services are dissatisfied, well, they might be dissatisfied with the price, but that's not the fault of CSD or the technology they're using. I don't see a problem here, and actually I don't see a blue screen of death. I don't see a problem that needs fixing in those terms. The distributed ledger technology became popular through Bitcoin, and it enabled relatively anonymous peer-to-peer trading, which globally regulators don't like that at all. And even if you get rid of the technology, replace it, they're going to still want central control over the service platforms, or the CSD or the trading platform, whatever that may be. And yes, the CSDs do provide quite a good service to the two most important players in the market. One of those is issuers, and the other of those are investors. Everything else is just preying on those two raw actors, essentially. Because if you didn't have an issuer, you've got nothing to trade. You wouldn't have a market. If you didn't have an investor, there'd be no trading. So I don't know. I don't see a problem that needs solving. Quite frankly, people will experiment, as they tend to do, with different technologies. Good luck to them. But I don't see a centralized CSD function being replaced anytime soon. Sorry, guys.
And you don't think tokenization, just very quickly, will change that dynamic at all? If everything stays the same, regulators want this, and we continue to issue securities and invest in securities, nothing will change. But what about tokens? They're different. They are a change of the model.
Yes, they're changing the model. People are playing around at the edges, but they're still going to want to implement a central service, even if it's distributed ledger. It's not going to be that distributed. It's not going to be anything like Bitcoin, because people have in this mind the whole Bitcoin market, and it's going to be huge, I suppose, astronomical mushroom growth of markets everywhere. Not going to happen. No, I'm sorry. It's still going to be a central service aimed at issuers who are trying to get investors.
Yeah, Chris, we're not talking about cryptocurrency here. We're talking about security tokens. Yeah. We're talking about tokenizing existing securities.
Yeah, I understand.
Tokenizing illiquid assets. And this is happening. We have a whole CSD, which is based on distributed ledger technology in Paris today. which is looking to tokenize, in effect, the commercial paper markets of Europe. This is not the sort of fantasy dreamt up by techno heads in Shoreditch. It's actually is happening to some extent, and you're seeing private banks and wealth managers all over Europe starting to develop trading platforms and issuance platforms, and actually finding investors, pioneering investors, albeit ultra high net worth individuals who are interested in investing in it as an asset class. So I'm not. Things might not change quickly, but they appear to be changing. That's all.
Yes,
Anyway.
but that's not about the technology. That's about the service that it provides. It's nothing to do with the technology. And I think that sorry, go ahead.
Yeah, Matt.
Just on that point, I think it's fair to draw the distinction between payments tokens and tokenized securities. I think that's absolutely fair. I think the similarity that we at Swift see is that in both those business areas, the retail usability, instantaneity, and that expectation that individuals have is seeping into the wholesale world, right? From the bottom up, but we do see that, and in our conversations with the 11,000 users of Swift, we feel that. Now, does that mean that necessarily implies we're going to move overnight to atomic settlement with no liquidity providers and all the things we're probably going to be discussing today on the panel? No. But I don't know what color the screen is. I don't know whether it's a screen or a field. And I know that every link of the chain we talk to say, well, our function has to remain, but everyone else is going to be disrupted in the services that they provide. All of that is true. It took us 30 years to move away from paper, right? And you'd think type it into an Excel sheet shouldn't take 30 years, and yet. But I'm not sure I would necessarily so cavalierly reject the premise that things won't be fundamentally different in 10 years' time. Let me put it that way.
Yep. So,
Dominic, if I may just add.
Okay, Alex first, then Roland.
Sure. So I think there's some interesting points here, and the points about tokenization is very interesting. And I know that you have got a number of questions which I think you want to pose to us later on about the use of different forms of payments, for example. But when you start to look at the wholesale capital markets, with in the case of securities in particular, you realise that the regulators want those markets to be well run. They want them to be not to be disrupted in any sense, in the sense of economic disruption and so on. And so it's essential that they have very, very clear ownership and records of title, and their safe transfer, and their preferences for central bank money. So most CSDs settle in central bank money. That is the least risky form of payment. When you start to go down the curve, you then go into commercial bank money, which is perhaps more risky, because you're then at the risk of the counterparties that you're dealing with, the commercial banks. And then you get onto all of these newer forms of payment mechanisms that you're referring to, which are tokenized, such as stable coins. They could even be Bitcoin, for example, which is not a stable coin. And the more you get down that sort of curve of payment side, because it is delivery against payment, you realize that actually you're dealing, for the large amounts of money, you're dealing with central bank funds. And until
it's a regulatory requirement.
Look at,
it's actually a regulatory requirement,
currency,
central bank money.
Then I think we're not quite there yet.
Okay, thanks, Alex. Yep. We're going to get central bank digital currencies, a whole different subject which we've discussed once. We're going to discuss again in January, so we'll come back to that in the new year. Roland, you wanted to say something?
Yeah, sure. And look, I think Alex has touched upon some of it, but I agree with Chris. Look, as at NASDAQ, we've got CSDs and we produce a CSD technology. And definitely, I think CSDs are here to stay. I think there are a couple of trends that also are emerging that go towards jurisdiction. I think legally, regulatory-wise, you're finding that regulators want control of physical jurisdiction. I think so. That's a very big element. and we see that especially in Asia as well, when you look at where, for example, when I was at Hong Kong Exchange, the big issue was where Chinese bonds would be settled. If you think the Chinese government is going to allow most of their sovereign bonds to settle in Brussels or Frankfurt or other places, I think you've got another thing coming. So anti-globalization and physical place and control of where it's a bit like the clearing debate about euro clearing, right? So at some point there's going to be an appetite for regulators and central banks to control their own securities, right? So that's one thing. Second thing is bankruptcy law. A lot of things, people trade in Euroclear and Clearstream and various places because they're comfortable with the jurisdiction. They have effective legal rights to liquidation and seizing the securities. That's one of the key things to make sure of that. Again, that someone needs to administer that, someone needs to control that. But I do think that having said that, and also the other thing is AML. I mean, in financial crime and that kind of thing, people regulators are very hesitant for something to become digitalized and escape from a residency, especially from a tax issue. So I think all those trends will mean there's a role for CSDs. Now, the technology itself will definitely push it to change. So everything you said about issuance and that kind of thing, a lot of it can change. And we saw that in Asia. We see that continuing. But I think going down to T0 settlement and digitalizing a lot. But I think in my experiences, the regulators first come to the market infrastructures and the CSD and to ask, okay, how do we do this safely? And unfortunately, the fintechs generally have a disadvantage there because it's the regulated entities who can actually, they've spent 10, 15 years of trying to prove to regulators why it's safe to do things. So there is a body of, there's a high threshold of entry into being a CSD.
Thanks. And, we're getting some questions coming in. John, I want to bring you in on this particularly, but can I just read out a couple of questions first? Because I think you'll want to comment on this. We've had some comments here from Andrea Tranquillini, who happens to be the CEO of ID2S in Paris. And he says the issue is technology or legacy. Lack of change is due to the fact that the incumbents are immobile. Newcomers might be primarily redesigning flow, as we did, and new technology is a tool to achieve a higher degree of efficiency, but legacy is primarily the issue to overcome. Do you agree? He goes on to say, I think Richard is right. Technology is the tool. The issue is on the processes that cannot be changed because of legacy. Tokenized assets are an additional opportunity the technology brings, but little will change for the CSD that already processes dematerialized assets. CSDs will remain centralized. DLT will allow decentralization of information and higher safety and a new relationship between CSDs and clients, but will not replace the CSDs. Anyway, the important point there is about legacy technology. One reason it's very difficult for CSDs and their users to change. A couple of other comments here. Chris Pryor Williard says, who performs the role of issuer CSD in the UK or the US? I think he's trying to tell us that we have no issuer CSD in the UK or indeed the US. He also adds, if centralization is essential, how many CSDs do we need? How many are necessary in a connected world? Anna Reitman says, isn't this a bit like asking, you talk about centralization of information, isn't this a bit like asking why you need libraries and archives if there's an internet? And that thought does occur to me listening to some of what's been said. You know, the whole promise of decentralized finance is that actually it's accessible by everyone from everywhere, whether you agree with that or not, whether regulators like it or not. And indeed, regulators do like innovation, so we shouldn't forget that. Vipin Mahabasingh from the Mauritian CSD says, how many securities are being held by the DLT-based CSD in Paris? Any other statistics? So perhaps Andrea Tranquillini, if you're listening, you could give Vipin some thoughts on that. But John, CSDs planning for tokenization. You've got clients, you must be seeing CSDs who are interested in this area as a business opportunity. What's your thoughts on what's been said so far and some of these comments?
Before answering that and try and answer that, can I just add to what we were just discussing with certainly what Roland was just saying, which is CSDs are not, as Chris was saying, that CSDs are not just about technology. There's trust that people have in a CSD, which is very important. That you want to know who the participants are, and the fact that you are dealing with authorized participants. You don't want to be suddenly find that settlement is occurring with someone that you shouldn't be settling your trade with. So, trust is an important matter, and I think that's where CSDs have been so successful in the last 20, 30 years, is providing trust. And I think, Chris, you said, that they've had to satisfy regulators, that they are trustworthy organizations to do the function they do. Tokenization. It comes up later, I think, the question to ask, but I think the biggest problem with tokenization is, yes, we can do tokenization, and what Andrea has done in Paris is laudable in the way that they've moved forward, and hi, Andrea. What I think the problem is what are the regulators up to speed on this? I know that IOSCO have done some work in this area, look in this area, they've done a paper. But the regulators, even in the countries, what do you do if a trade fails and you need to try and get an asset back? What happens there with a tokenized item? I don't know the answer myself. Is it going to be different if I'm doing cross-border as against the domestic? There's a whole series of issues there which can't be answered, and I'd love to move forward on before we have tokenization, springing up all over the place.
Mm-hmm. I'd like to move on now to the nature of the opportunity that's here for CSDs, because I think there is one. We talked a bit defensively about them so far. Before I do that, I'll just read a couple of other comments. Vipin Mahabasiyang from Mauritius again said, real-time settlements already possible today with BIS Model 1, DBP, and Swift GPI. Do we really need DLT to achieve real-time settlement, especially with pre-funding? That's a reasonable question. Richard, perhaps you'd like to give us an answer on that. Pre-funding is a deterrent for DLT in general. Sebastian Grevery has said that if CSDs exist by virtue of centralized national legal and regulatory mandates first, their defined functions second, their market structures third, all of which are pretty much technology agnostic. Technology affects all of the above in terms of costs, efficiency, etc. Then this blue screen of death question is a bit of the case of the tail wagging the dog. Wouldn't the question be more, what is the national legal and regulatory framework speed of change? Glacial permafrost comes to mind, but also global warming is around the corner. I think there's more than
Brexit is around the corner too, sadly, over here.
What is?
Brexit.
Well, we don't want to get onto Brexit. We're talking about CSDs on a global scale here. I can see it's a problem for Euroclear, but we'll talk about that another time. Anyway, we'll sort of move on, I think, a bit, and I'll pick up some of these other comments which are coming in thick and fast. I can see we're engaging the audience pretty thoroughly here. But what's the opportunity here for CSDs? Alex, what do you think CSDs can get out of tokenization? What would they do? John has raised the question of trust, for example. We often hear CSDs would become, the governors of permission DLT networks, and so they'd decide who could join the network to impart trust to it. But there are probably other things they could do. What would be on your list?
So I think the opportunities obviously. For us, we've got the ability to look at other asset classes because, the tokenization is often in a lot of other different asset classes, as we've seen, and it's really, in my mind, it's not really to do with the tokenization itself. It's more really to do with the fact that the whole DLT debate has focused attention on particular areas. I mean, let's take trade finance being an obvious one. That process flow and workflow amongst all the suppliers and financiers in that flow has been reimagined. And if that sort of simplification of flow takes place, then that standardization enables an improvement. Now, to me, that's more about, yes, it's prompted from the whole debate around can you issue a token and then have that transacted around and settled, simultaneously. But at the end of the day, the token is one representation of what is called the truth. Another way to do one representation of the truth is to have it in a central body. And I'm not saying necessarily that is right and correct, but it's what our regulators, certainly for the the high value amounts, they require. But I think for me, the opportunities, for us, certainly there are several other markets out there. There's a way then if there are other markets and participants have their liquidity with us and with all the CSDs, and they could reuse that liquidity in different markets. Again, it very much comes down to a point that was made earlier. I think John made it around the regulation and also as to Roland's point, the legal certainty. And it really is. I do sort of one of the questions we got just now was around is it the tail wagging the dog? Is it the technology wagging this? I think for me it's the regulatory harmonization and the legal harmonization, which is just so important to be able to get scale. And then second to that, there's almost a horizontal aspect to this, which is the workflows amongst people, amongst organizations, which of course has been hugely simplified over the last 20 or 30 years by standardization that's of messaging that Swift has driven and so on. So that's really at the heart of it for me. And if everyone adopted the same system every day, if everyone adopted the same DLT every day, then we'd all be harmonized. But the problem is no one's going to do that in one go, sadly.
Thanks, Alex. So you've given us some very interesting thoughts. So that wasn't actually the question I asked, but the question I asked is what can CSDs do here? But let me give you some examples that have been put to me. Okay, so one I suggested to you a while ago, Alex, was to be the governors of these permission networks. They could get a banking license. I mean, you guys have one, but not every CSD has one. You get a banking license, start doing some banking services. You could start, doing repo and stock loan with tokens. You could get into utility and distributed finance tokens. You could expand into new asset classes, fine art, collectibles, real estate. You could start, there's a job to be done just safekeeping the securities behind asset-backed tokens. You could start to provide digital wallets to investors. You could start to do KYC AML checks off of digital identities. You could do tax management and reporting. You could net trades for settlement. A number of people have started bringing up this pre-funding question that would help to solve that. You could start to support linkages between tokenization platforms that are operating maybe in liquid asset classes and the existing securities markets. There's lots of exciting opportunities for CSDs.
There are lots of exciting opportunities.
Dominic, are you saying that CSDs should be CCPs?
No, I think these are all jobs which need to be done.
And they're all jobs, a lot of those you referred to is what the CSDs are doing in regulated markets today. Yeah. And they're doing it for securities, right? And they're doing it for high value securities. Now, the question is, from a regulatory standpoint, are the CSDs allowed to do those other things? And, at the moment, the regulators under the CSDR regulations in Europe, they don't, fully allow these things at all. Nonetheless, the regulators are looking at, revising CSD regulation and also the, more widely, a number of them, particularly in the States, are being very advanced in terms of looking at, specifically around DLT and tokenized decentralized finance and how they're going to regulate that. And it's really those openings that then create, the opportunity set. I mean, everything that you've referred to is very much down to any CSD outside of their core business, but possibly in separate legal entities, to look at those opportunities and to say, yes, we can leverage our technology today because it already does it, and we could go into those markets and we could offer those services. So it's very much up to, I think, each CSD to decide their own appetite to these markets if there is a business case.
Yeah, I think I'd add to that what Alex said. It's the business case and liquidity, right? You can do all of those things, but if you don't have the demand and the supply and the liquidity, you're not going to get any traction, right? So you need the trust, you need the regulatory license and the ability to set up shop, but you need the customers. So I think, yes, there's an opportunity to do all of those things, but I think in terms of running CSDs and understanding what says each CSD has to understand who their market is, who their customer is, and it may not be cross-border. It may not be in half of those things. It's got to be understand what's your business case for it, right?
Richard, could you address that one specific question which Vipin raised, I think, about pre-funding? But could you also give us some idea of what, if you were to give advice to a CSD on how they should respond to the tokenization opportunity, what would you say to them? So if you could deal with those two questions, that would be good.
Sure. So actually, I had the good opportunity to advise a number of CSDs who are building out their own digital CSDs. And actually, each time we come into this conversation, we point out the word centralized that's on the front of their title and ask what are they intending to do? Because if all you're intending to do is re-platform to an emerging technology, which is a huge spend, and not actually change any of the business or people processes or any of the business models, then you might as well have remained with the database that you started with that created you in the first place. So actually, if you look at a centralized securities depository, they are well positioned actually to take on this new technology. The regulatory environment, as one of the audience has already pointed out, is glacially slow. So you are going to operate in that space. And the new ones that are joining look very similar to the old ones because they follow the same regulatory handbook. Doesn't matter which jurisdiction they're in, they will look like they're incumbents that they're fighting, which means the regulator has an awkward debate or awkward balance to have between regulation and control. Centralizing is the easiest, simplest solution, and decentralizing to create competition. And if you look at the conversation now as about what features does the technology give us, atomic settlement is obviously a feature that you can achieve, but actually does it have a business case? In many cases, actually, the way we fund and the way we pay for the services that we rely on comes from that lack of pre-funding. And there aren't many institutions who want to do pre-funding in this space. And what we do find is those trying to bring to market an atomic settlement, and there are a number of fintechs out there who are doing it, don't tend to find that it's actually something that their clients want, even though they've been able to build it. So I think that answers the obvious one. If you look actually at the most obvious thematics here, most of the financial institutions got involved in Bitcoin because of the underlying technology blockchain. So the distributed ledger technology that we've been looking at for the last half decade, they've been looking at it from a bottom line efficiency play, a cost efficiency play. And that's been actually quite successful. We've done like 25 years of intra-house reconciliation, getting to single sources of truth inside the banks, the financial institutions, and the market infrastructure. And we've reduced the cost base on those quite successfully. But actually, we still got hundreds, if not thousands of people doing reconciliations across that landscape. And actually, one of the uses of the technology is reconciliations. Doesn't matter if it's the Italian banks that have come together to create a reconciliation system amongst themselves to reduce the inter-bank or inter-institution reconciliation. So that bottom line efficiency play is now playing out. It'll take 25 years, just as the 25 years of making it efficiency, certainly in my career, 25 years of getting the efficiencies out of our bank. You're now looking at two banks trying to work together to actually make it. So that's on the bottom line efficiency. But that's not the really good bit. And the reason we find ourselves here today, and to the audience's question as to, this blue screen of death looks like a tail wagging the dog. Actually, what we released back in 2018 with the ICO market was a genie out of the bottle around the ability to raise capital totally unguarded and totally unregulated in a wild west, and allowed issuers and investors, the two primary actors in this ecosystem, to come together without regulation. They discovered very rapidly why they needed regulation, but we've let that genie out of the bottle. And here we are today, now discussing, actually, can we put the genie back in the bottle? It was really nice when we had just a centralized repository with a database. The answer is
halfway
no, you
back
can't.
in.
No, you can't. You can't get the genie back in the bottle. So now's the conversation is, how do you control a fabric that is raising capital to investors? How do you get it back under a regulatory environment that both provides competition so that we don't get the pricing power of monopolistic infrastructure, and also at the same time control it from a regulatory perspective?
I'd like to have, Matt, I'd like to bring you in with some thoughts on what CSDs should do. Before I do, I just thought I'd throw in this point from Andrea Tranquillini. He would know because he's running a DLT-based CSD. He says T2S does not require pre-funding. Auto-collateralization for eligible assets for collateral reduces to a minimum the need for cash. So in the money markets, at least, it's not a problem. One other thought, just to prompt you a bit, Matt, is from Nat Say. He says the banking space that services the retail banking sector is proving to be the most forward-thinking sector in the financial world, evidenced by Apple Pay, Google Pay, etc. Are we thinking too narrowly here? Do we really think that a company like Square, that has the slogan Cash App, spend, spend, save and invest, no bank necessary, will stay out of the institutional space forever? John mentioned trust. Younger generations prepared to put their trust in very different organizations compared to those of their parents and grandparents. That might, of course, be their lack of experience, but John, perhaps you'd come back on that in a minute. But first, Matt, what would you tell CSDs to do? You're at the center of this, or this web of a very complex ecosystem of which the CSDs are part. What would you recommend they do if they asked for your opinion on how they should respond to tokenization?
Well, I would be very humble, of course, because we don't want to give recommendations to our owners and shareholders and board members. But having said that, one of the points you raised about the function of a future CSD and something that's come up before, meaning to be the guardian of the network of a set of securities tokens that are held at that CSD, let's just use that verb. Our recommendation at Swift, and this is our nature to try and be a mutualized global platform, is to say, if everyone builds that around their CSD around the world, then you're duplicating effort. And this is, we believe, not something which is in the competitive, but rather in the cooperative sphere. So our recommendation, and putting our money where our mouth is, we're already starting that work, is to think together, right? Are we moving towards a model with a single fabric, multiple fabrics? How should those fabrics talk to each other? If we posit that there will be a major shift in the representation of assets, whether it's Picasso's or General Electric shares or anything on that spectrum, we posit that let us work together and understand what is that overlap in the Venn diagram of functionality that's in the cooperative space. Because however you build it, whatever technology you build it on, you're going to need the very trust that John, as someone who worked at Swift for a long time, is natural that you point out. And that structure of trust exists, even though a lot of rules have changed over 30 years in the CSD and the capital market space. So that would be my recommendation in a nutshell, is let's work together. On what? On the technology, on the identity, on the cybersecurity, on the standards, perhaps on the flows, and certainly on the reference data of these various instruments. There's a lot to do there, and I just listed them off like a machine gun, but that would be my executive summary. Just to try and answer one of the questions that came up about how big the size of this might be. Many organizations have their crystal ball that they look into. I think our central model, our central forecast is within a 5 to 10 year time frame. We believe that the size of the global stock exchange's outstanding positions and the size of the tokenized positions across the world, right, to compare apples and oranges a little bit, will be comparable, same order of magnitude, right? So we don't believe that one will predominate be predominant over the other within less than 10 years. That's our central view, I would say. Mm-hmm. There's a lot of other questions and that you asked, but that would be our recommendation to CSDs. Come back to that is let's work together. All of you have, based on your regulation, your business cases, size of your market, specific parts of all those opportunities that you want to work on. The technology and the trust and the network around that is probably largely in the cooperative space. That's what we believe. Let's work together.
Okay, but to be clear, Matt, is SWIFT offering to compare that working together, that community effort to bring all the various interests together? We're going to talk in a minute about who has an incentive to change and who doesn't. Is SWIFT offering to bring everyone together to start working on the creation of this transition from where we are now to the mixed system you've described in 10 years' time?
I'm going to be careful in my wording here. Our CEO at Cybos just a couple of months ago said that it is our role to make sure that we moderate the conversation and understand the impact on all of us of where we believe this will be going. So we are in principle the forum to discuss this, or certainly an important forum to discuss this. Whether everyone else agrees with our central view of that it will be a transformation within that time frame, let's discuss. This is not very different from what we've heard from many securities MIs and global custodians.
Okay. Here's a question you won't want to answer, Matt, from Chris Pryor-Williard. Why doesn't SWIFT become a networked global CSD?
Why don't we become a CSD? Well, very simply,
a global network.
That is, very simply.
It's not stupid. You're in a great position to do it. You've got connection to all the relevant points. Mm-hmm. You could do that in principle if your owners and members allowed you to.
Well, you have very deep pockets, Matthew.
We are a humble cooperative, right? 3,000 people across the world. So I think that's certainly not the central view or the intention. I think our oversight and our ownership would have a lot of thinking to do before we get there. I don't want to exclude anything if we take a long enough term perspective. But anything other than that, I'm going to have to disappoint the person asking the question. I don't believe that's
okay.
That's the intention here. There's a lot we can do. Becoming the world single CSD is not on the current shopping list of what we're looking at right now. Let me put it that way.
Okay. Well,
I can't, Dominic, if I may.
Yes. Just.
I can't emphasize enough about my point earlier about standardization. And, you need to get not just the CSDs, but you need to get all the players around who are involved in the whole post-settlement chain involved. So you have to have the CCPs, you have to have the custodians, very importantly, you have to have the broker-dealers. You've then got to do this on a national level or on a local level, and also with the international markets as well. And then you've got to get the regulators on board to try to standardize it. It's a big job, but someone's got to, if someone can take that on, like a SWIFT who's linked to all these participants, that would be really good.
Okay, thanks, John. I'm very conscious you've been itching to say something for a while. So, Roland, I can see you want to comment too. But John,
if I was a global custodian, I'd feel that the way that these individual sort of technology pieces are moving is that we'll go back to the 80s and 90s, where you have a row of terminals sitting there, and you're having access to all the various CSDs around the world. So you'd have you'll have a set of not global APIs, but individual APIs into all these initiatives. So you can be almost going backwards. But I'll let the others come in.
I'd like to just, before Roland, before you say something, I'd just like to read out an observation from Marianne Callahan, who knows a lot about this topic. Operating on a shared ledger, even when replicated with each participant, still requires a focus on who owns and who governs, another element that financial market infrastructures have evolved. New DLT platforms are therefore themselves collective ecosystems, and therefore must even compete with CSDs on a governance level. Meanwhile, aren't CSDs well positioned to adopt the new technologies in order to add and evolve services for digital assets using standardized practices. I think she is saying that CSDs should be moving into this space, using what they've learned and what they're good at, and standardizing it. Roland, you were going to say.
So I think one thing, and I'll address that comment as well. So there has been a lot of work in the industry, and I know personally the ISA, the International Association for Securities Settlement, Collins group has we started a lot of work in the last couple of years doing that. So I think it to Alex's point, absolutely agree. We've got to come up with standards for interoperability, movement, and that kind of thing. It can't be in isolation. It can't just be from a cash network like SWIFT. It has to be from a group of securities experts on that side.
SWIFT is 60% securities. Sorry to interrupt, because I hear that 60% of the traffic on SWIFT is securities. Okay. Just as a data point.
Equities experts then, right? Then I would say to the other point, I mean, NASDAQ's been an early adopter of DLT going forward, and we played around both in the tech space and also in our products, quite a lot of that. I absolutely think DLT can be applied to the CSD space, and it is a game changer in the sense that used properly for the right use case, it can bring benefits. There's a lot of effort still in the industry, both in the US and Asia, to narrow the window of settlement down to go towards T0. In Asia, and especially the China link, which I was familiar with, T0 settlement is absolutely necessary. And to enable cross-border affirmation and confirmation and allocation of trades, something like DLT is a serious consideration in that, because you've got literally hours to settle trades, especially in those kind of markets. You don't have 2 days to do that. So anything that helps that technology, and once you get the use case to do that, and it gets implemented in a jurisdiction in a CSD, then and regulators are happy with it and it's functioning and it's matured, then it's very easy to replicate that functionality in other places. I think it will always be a challenge in the next couple of years to get the first large-scale DLT application in a major jurisdiction. But once that happens, I think then you'll probably see a quick acceleration.
Thanks, Ray. Now, Chris, I'd like to bring you in. Can I put a question to you in this form? It occurs to me that if you look at the world of CSDs, around half of them are actually owned by stock exchanges. They're in these vertically integrated silos, if you like. And it's interesting that the response to blockchain, ASX, Hong Kong Exchange, Singapore Exchange, suggests that exchange-owned CSDs are very open to change. Is that your experience of talking to these organizations as clients? Do you think that the exchange-owned CSDs are more open to change than the standalone CSDs?
Yes and no. I mean, they're all struggling to increase their liquidity or maintain it at times when the market is depressed. Everyone is looking for new ways to bring new people in, and CSDs are not brothers. They fall into two different cultures. The omnibus CSDs don't particularly serve either issuers or investors particularly well, and that's most of Western Europe. So everything south of the Channel, basically, Germany, France, Italy, they all have these omnibus model CSDs, and I can understand the attraction of something like a distributed ledger model for them. North of the Channel, though, the Scandinavian countries, things are a little bit different. Those guys are quite well served. So
the interesting part here is that obviously they're well served when the financial market infrastructure, it doesn't matter which layer you're in or where you're at in this ecosystem, is making good profit margin, because you can pay for the services downstream and beneath you. But as the margins get squeezed from the buy side and the sell side, which is clearly the thematic you see on the sell side and buy side, they are pushing now, and having stripped out over the last 10 years since the financial crash, having stripped out the direct costs inside their own houses, they're now looking at the indirect costs that they pay from out of their P&L into the financial market infrastructure, and they're squeezing that financial market infrastructure and asking it. So when you get around a table around a board who own a CSD, there'll be buy side, sell side, there'll be the exchanges, there'll be lots of different interests around there, and they're all talking about the same thing, which is we're going to get rid of some of the cost. But what they can't agree on is whose lunch they're going to eat. And
well,
actually, when you get
mine,
there,
they tend to like to eat. That's the
value
problem.
price. So the conversation we're having in the blue screen of death is you're watching a thematic where the value chain is being squeezed, and the participants that have been there for 30 years are getting squeezed, but they can't agree who's going to lose their seat.
Okay, hang on. There's a lot to unpick there. The first of all, it's what we do as human beings. We trade things. It's something that's so natural. It's built into us at a genetic level. That's easy to sell. People like to get in touch with each other and sell and buy stuff. Look at the success of eBay. Bring it to the financial market. Now, we have so many intermediaries in the middle feeding off of those transactions. Those are demons that most people want to get rid of when they go to the
most obvious one, which no one likes the analogy, but actually the Uber model. Uber did not enter any market by talking to licensed taxi firms. Airbnb did not enter any market by talking to hoteliers or any of those types of incumbent middlemen in the center. They talk to guests and room owners, they talk to drivers, and they talk to passengers.
But
and
now,
actually, that moment
in this particular world, now you have the regulators in the way, and they are notoriously slow at changing things. I mean, okay, one of the main, I suppose, actors that I come up against in my professional life are central banks, because the regulations say in most places, it's got to be central bank money. And there are good reasons for that. You are protected under the bankruptcy regulations when a participant fails, if it's central bank money. If it's not, hard luck. So you have to deal with central banks, and I cannot comment on their ability to regulate monetary policy in a country. I am not qualified to do that. But
I agree
they provide a really poor service.
I'd agree. Yeah, I'd agree with Chris in terms of the importance of central banks, and actually, I think the central banks could set the tone for this. I know the Chinese central bank is working on digital currency. If that takes off, you'll see a lot of change, because they can affect change centrally very quickly. And I think if the Swiss, I think if the central banks can create a central bank network within their jurisdiction that does that, then that replaces fiat currency, I think a lot of things will unlock pretty quickly. Going back to Alex's point earlier on having to settle in central bank currency.
So some of them are more forward-looking than others. Others are, God reports to them. That's how they tend to approach the world.
Central banks are leading this debate. The CBDCs are going to happen. This is a question of when. But we'll have a whole debate on that in the new year. So I hope you'll come to that. I'd like to read out some observations made by Sebastian Grevery here about Richard's point about the genie being out of the bottle thanks to the ICO boom. Richard made a great point. Genie's out of the bottle. The technology is radically transformative, but the legal and regulatory frameworks are not there yet. So drinking out of this bottle suffers prohibition to a large degree. And I think that's a lot of what I've listened to this afternoon, is everyone saying, well, the regulators do or don't want it. I think we must remember regulators actually want innovation. They want finance to be cheaper to consumers. And it costs 200 basis points. The financial services industry cost 200 basis points 200 years ago. It still costs 200 basis points today. Nothing has changed. Technology needs to change. I think regulators and central banks probably do want to change that. Sebastian goes on to say, DLT crypto CSD option. The CSD option follow the trading layers participants' appetite to develop new markets and assets, for which liquidity is not already trapped in existing silos of legacy infrastructures, and start building them there in concert with participants. In other words, what Matt was saying, really, let's get on with this and start running some pilots, getting some things done. Governance challenges. Incumbents really have an incentive to change. That's true. Given the technology's ability to redistribute roles, governance issues will prove difficult to address in any case. Although I think we've agreed CSDs have a natural role in governing permission DLT networks. The number of failed stories in developing market utilities between financial participants is telling. So I've got a few observations there we're doing. an interesting observation here. If the opportunity is so great, Alex, you might like to think about this. Why are Euroclear and Clearstream not exploiting it already? What's the panel's view on atomic settlement and whether the requirement to pre-fund adds a benefit to current market participants? I think we've dealt with that.
No, no, we haven't.
No, we haven't. And
well,
Dominic, can I pick up on a couple of those points?
Yes.
So if I may, in terms of the why we're not doing it already, well, clearly, CSDs, and we're not the only ones, are exploring DLT. They're exploring crypto. We had a great deal of input to the ISA paper on crypto, which is, and of course we're very interested in that. If it becomes an asset class in its own right, and the regulatory boundaries allow us to take advantage of that. But the other point is that why we're not doing it already. Well, it depends what it is, but if it's why are we not replacing our technology by DLT? It comes down to, well, there isn't a problem with our technology, and I think that most CSD technologies, in that they if they are replacing it, they may consider DLT, as the Australian Stock Exchange has done. But really, what they face there is a massive project with introducing a new system in a new market in a market, and they're suffering perhaps because they've been delayed. A lot of problems that take place when you implement large scale new platforms, and that's no different now in a DLT space than it is in a conventional space.
Yeah,
and having the cash there, the way that a lot of the CSDs operate, where they've got access to the central bank money, and they're moving it in real time. And again, there was a point made earlier about collateralization. Well, a lot of these CSDs do auto collateralization, so they're able to generate liquidity for their members as well. And having that sort of centralization, that pool of assets, enables that collateralization to be a big factor and a really important thing. So it really comes down to what question are we trying to solve here? And for me, the big question is, how do we take the cost out of the whole market? And someone mentioned earlier, well, the cost in the market, 200 basis points or whatever. I can remember when I was a consultant not that many years ago, looking at the whole end-to-end cost, and it changes from time to time. About where does the cost of a trade come in, and where does the cost of clearing come in, and where the cost of a CSD, and where does the cost of the custodian, and where does it differ if it's local or if it's domestic or if it's international? Are you using sub-custodians and so on? And if you look at the whole chain, the CSDs are typically a very, very small part of that cost. Now, I'm not trying to defend the CSDs in any respect, but I'm just saying that's a real observation. And I think we need to radically look at the whole thing and reimagine it. But then, in the context of building liquidity in one particular asset class, perhaps, and then building it up from there. But it's a notoriously fickle and challenging problem because, as people made comments were made earlier, no one wants to be the turkey that votes for Christmas.
Okay, so we have this complex system involving custodians, brokers, stock exchanges, clearing houses, as well as CSDs. And if we take that 200 basis points, a lot of intermediation going on, and nobody wants to be knocked out of that value chain. Are we saying that each of these pieces is actually very happy with the status quo because it kind of divides up the 200 basis points very satisfactorily between them? In other words, are CSDs like the useful idiots of the custodians, because the custodians become the guardians to the CSDs, and then the custodians themselves become the useful idiots of investment banks, who themselves are at the top of this chain, intermediating with the buy side and so on. So if we ask ourselves, what are the incentives actually to change the status quo? If we accept this technology might be able to reduce the cost of finance to consumers and to corporates, how do you get this process underway? Matt has given us the one solution of a sort of industry summit, a continuous summit where the various interests come together and try and work it out. Chris Pryor-Williard has given us another idea here, which is, we shouldn't have a discussion, we should just have competition, because competition will have a salutary effect upon the incumbents. Richard's point about Uber and Airbnb, just coming in and overturning the thing from outside. But if we agree that this technology has potential, I'm not sure that all of us are, but let's work on that assumption. How do we go about initiating this transition over the next 5, 10, 15, 20 years, so we end up with a more dynamic, lower cost, growing market?
If the technology really had an advantage, they would use it. I mean, CSDs are not stupid.
I don't think that follows at all, Chris. From everything everyone said, is that you've got legacy systems, you've got incumbents who are not prepared to take that up because it means knocking them out. So I don't think that. I think one of the points has been established this afternoon is that doesn't follow.
I think.
Matt, you wanted to say something. Matt, have a go.
Yeah, let me. So firstly, I mean, call it a summit, call it work together. That is always going to be Swift's view. I also think one of the points was, can we start domestic? That was one of the proposals. I think what we've seen in our discussions, maybe it's not so much start domestic as start with particular asset classes or sub-asset classes. The reference to trade finance. Why is DLT successfully being implemented by Voltron or whatever they're now being called? Is because they're moving away from paper, right? Whereas moving away from 1502 on databases which have been working well together for the past 10 years and are fine-tuned, the business case for the jump in efficiency isn't the same. And yet there are asset classes, not the Picassos, which are the rare birds, but maybe corporate bonds or something like that, where there probably is a bigger gap in efficiency that you could gain, use the technology which is looking for a use case that's broad enough, right? Let's work together across geographies, try it out. And if it works, to Chris's point, and Richard's points and everyone's point, then we'll propagate elsewhere. So beyond the generic idea of let's work together, let's perhaps find the right type of asset, where there's interest at the wholesale and retail level. Because in the end, to answer the other question you had, why are we doing this? Are we going to vote for Christmas? No. But if the retail customers and the issuer and the investor are looking for faster settlement, more transparency, corporate actions at the click of a thumb, whatever, well, the whole chain is going to have to, at a wholesale level, probably react to that. So that's my attempt at an answer, Dominic.
Okay. We're sort of already 5 minutes over our time, so we will have to stop quite soon. But Jamie also makes a point here, just a note for the token space to get the size of the traditional markets. This is a point you raised much earlier, Matt. In 5 to 10 years, it'll have to grow by 300 times. I'm not sure how realistic that is.
In the crypto space? It's pretty realistic.
No, he's talking about Matt's observation that we're in this slow transition in which the tokenization becomes of equivalent size to the current security market.
So that's an interesting point to segue into, which is you've got a regulatory environment which is slow moving, glacial. Doesn't mean that it isn't changing, and it is slowly decentralizing. They are recognizing some of the pieces of centralization that they enshrined into the regulation is changing. It's a point that we made earlier. But actually, we always enjoy the last line of Animal Farm, where you've got this phenomenally fast-moving, and I'd never seen it before, fast-moving crypto space, which is innovating at a breakneck speed. And on the other side, you've got a slow-moving, incumbent, overly regulated environment. Since the 2008 crash, the regulations just come at us like a tsunami. And actually, those two worlds are merging. A day doesn't go by one of the crypto established financial institutions takes a regulatory license. Kraken just became a bank, and it's no surprise that you then see the incumbents starting to get interested. JP Morgan's changed their tune on JP Morgan coin and on Bitcoin. Those two sides are converging, and they are absolutely opposed at this moment. But over time, you will see them. So as we say, the last line of Animal Farm is the creatures looked from man to pig and pig to man and could not see the difference. I don't mind which one is the pig or which one is the man. At the end of the day, over the next 10 years, those two things are going to converge.
Yeah, but Richard, that was a dystopian future he was describing, huh? That was a dystopian future.
Mark Elliott says, I remember turquoise being an equation where large players working together had an effect on the financial market infrastructure space. How long lasting is another question. Chris Pryor-Williard just points out that I seem to remember a previous Future of Finance seminar, estimated annual cost of post-trade processing in the UK alone is 90 billion, 200 basis points. That means 90 trillion. No, can't be right. Anyway, he seems to think there's enough budget for change to take place. But look, we're sort of 7 minutes over now, so I think we should try and wrap this up. But before I do that, John, you've been very quiet now. Is there anything observation you wanted to make before we go to our final question?
No, go to your final question.
Okay, you deal with this first then. And my question is this, that as I look at the traditional securities markets, they don't seem to be particularly healthy. There are a lot fewer IPOs, a lot fewer listings taking place. A lot of mergers and acquisitions have taken people out. A lot of private equity funds have taken other people out. So the core market in which CSDs are operating, along with all these other members of the ecosystem, is not in the rudest of health. Is it possible that tokenization could be an injection of new energy and health into a system which is not in the best of spirits at the moment?
Yeah, it could be. I mean, it could be that you'll have new exchanges being set up, which are tokenized from the beginning. And then they may find that issuers will want to go direct to them immediately. Mm-hmm. I don't know. I mean, yes, a lot of exchanges are suffering from lack of flotations, as you know, and the income is going down. But yeah, I think there is a risk that you could have new exchanges being set up. I mean, in a sense, what Andrea and what they've been doing in Paris with I2DS, and they've set up an exchange for the commercial paper. So that's a new exchange.
I think from the NASDAQ point of view, we don't see that picture. I mean, obviously, coronavirus generally has been unfortunate, but digitalization and the trend towards tech companies and biotechs has obviously benefited us. And we provide a safe place both in US and Europe for those companies to come to market. And you see that coming. And I think going to my previous organization, Hong Kong Exchange, they've had a whole load of listings, right? So in the tech space. So tech companies are still looking to list on normal exchanges, and again, it's a question of liquidity. So I think certainly in Paris, in Switzerland, there's attempts at digital exchange, and they will come along, right? But I think it's a bit overplaying it, saying it's the death of normal exchanges or traditional exchanges.
I wasn't saying they were going to die. I was saying there's potential for new exchanges popping up.
Yeah. Let us scratch.
There's a lot of companies being kept in private hands or taken private, and that's the challenge in some countries in Europe.
Uh-huh.
Yeah, some. Yeah.
But Alex, what's your view on this final question? Tokenization. We look to the future. Tokenization, is it going to be helpful or negative, or just have no effect whatsoever on CSDs?
So I think my personal take on it is it's going to be helpful in that it gets the debate about the whole model and the whole end-to-end model. And if that can generate some standardization across the value chain, and that standardization has got to come, to Mathieu's point, maybe you start it by asset class and you do it that way, first of all, and you bite off small pieces. And it's got to come in markets, I think, which are not very well served at the moment. If you look at the securities market as a whole, they're pretty well served by the current model, and certainly by the CSD side of the equation, which don't incur a lot of the costs. So, you've got to look at where the problems are and start there. But I think for me, if DLT encourages people to rethink, standardization and how you could get people using the same system, the same standards, whether those standards being DLT, I think that would be so very important.
Thanks, Alex. Chris, you've been a little skeptical of whether DLT has.
I'm sorry I've come across that way. I mean, DLT is a really fascinating technology, and I think as soon as CSDs can find a use for it or some golden path in which to bring it to fruition, they'll do it. It's just that the problems that everyone's so excited about are not in the CSD. They're in that whole value chain and other systemic problems. Those are the ones that you're trying to fix currently. So I don't know. We'll see. I mean, the proof of the pudding is in the tasting. So when someone manages to consume this pie and has no ill effects, I think a lot of other people will start to follow suit. But it's not a huge rush at the moment.
I think the concern,
a lot of investigation going on, but I think
the concern for CSDs is that you're right. They're at the end of this chain, and their revenues and business models are affected by what happens further up the chain. So if people stop issuing securities in the credential way into CSDs, people start trading on tokenized exchanges rather than on official exchanges and so on, that eventually cascades back to them. And should they take the lead in trying to accommodate these new asset classes before they get overtaken by them? I think that's what.
But the tokenized exchanges are still an experiment, and we haven't run it for very long. I mean, the experiment of stock exchanges and the whole financial industry, we've been running that for some time now, a couple hundred years. So it's got a good CV. The new kid on the block, no, we're still waiting to see what happens with him.
Yeah. Okay. Well,
fall off his skateboard and break his neck, just as likely.
A final thought from Vipin here. Market infrastructures are not doing well because the global economy is struggling. DLT won't change anything on this front. Don't know, Richard, to think about that in a while, but first let's Matt, a final word from you. You've spoken eloquently about this transitional process and how you think that a community effort can make it less painful than it might otherwise be. What's your thinking about whether tokenization has the potential to rescue the securities markets from, despite what Roland said, in the United States, United Kingdom, at least, you're seeing a lack of listings and a lack of IPOs. What's the role which tokenization can play in restoring these security markets to health?
Wow, that's a broad question. I think that the idea of democratization of finance and starting with the retail space, bringing fresh capital, new money to new issuers, I think that already exists today. So that is happening, right? And like many technologies, they seep in from the retail level and go upwards and upwards. The example is the steel mills, which competed with Pittsburgh in South Korea, started with lower quality steel mills and then went up the value chain or the quality chain, right? So I think it's possible. That's not our area of expertise, but personally, I think it's possible. Now, to the point about dystopia, right? And the last line of Orwell's book, the name is escaping me right now.
Animal Farm.
Yeah, Animal Farm. What John was talking about with the various terminals, and this is me connecting into that DLT, and this is me connecting into that DLT, and this is me connecting into that API. For Swift, that's dystopia, right? And I suggest, try and avoid that intermediate step where we build all of these separately and then consolidate them. I mean, perhaps self-servingly, I would say let's start by building them together from day one.
But is it too late, Mathieu? It's already started.
That's fine. It started at the retail level where I don't think all of the wholesale participants are looking to interact.
What SIX is doing it, ASX is doing it, and I2DS, whatever I keep forgetting the name.
ID2S.
Thank you.
Rest assured that we talk to them frequently and at all levels, I guess, is what I could answer.
Thanks, Matt. Richard, a final word from you, perhaps. We just heard Matt talk about, Swift is clearly reconceiving itself as a sort of network of nodes. It's kind of... It's,
your words.
My words, but it is a network. And what we're talking about here is a network future. Are we? And what is that going to have a massively positive effect upon the securities markets if we look ahead 5, 10, 15, 20 years?
If you look at broadly, I mean, just respond to Matthew, he's a humble cooperative created as a response to Citi's attempt to create a proprietary platform in the early 70s. So actually, we're watching a bit of the same movie again, as undoubtedly we will see a lot of individuals attempting to try and create a proprietary platform that everybody should come onto. But actually, if you look across the industry right now, it is early days. We've got a number of new digital exchanges Some of them are creating digital CSDs as well. Those are brand new with new infrastructure underneath. And they have the opportunity to compete against their incumbent domestic CSD and their domestic incumbent exchanges. Most won't. They will find new markets and new spaces that will eat away at that exchange and their incumbents. And that, sadly, is what we're watching. It's taken 12 to 18 months to get a regulatory license. You've seen Archax now in the UK. SDX is nearly there over in Switzerland. And that's just here in the UK and in Switzerland. Now, out in Asia, we're seeing it move at an even faster pace. And each time one of these new exchanges comes to life, it breathes competition and it breathes innovation into this space. And what will undoubtedly occur is that one of these will get it right. They'll find something and this will unleash. So right now we're watching the kind of, if you want to see another movie, the intranet days when we were playing with the new technology to create little intranets inside our houses, maybe create an AOL to try and attract everybody on, and sort of the attempt to sort of own the US consumer in the internet. But actually, we haven't even seen the Facebooks, the Googles, the Netflix coming onto this space yet. Maybe one of the ones we've just seen, the Archaxes or the SDXs, might be one of them. Or we've got to wait another couple of years for one of these to create.
Thank you, Richard. Sadly, I'm old enough to remember AOL, the walled garden of AOL. I think I was an early subscriber to it, and how ridiculous it seems in retrospect. A good point to end on. We've been at this an hour and a quarter. We've barely scratched the surface of this topic. So I think we can promise that we'll be back to talk about this again next year. I'm afraid, gentlemen, you'll all be invited back for round two. But I think we must stop there because we have run on far longer than we should have done. So I'd like to thank our panelists, Alex Powell, Richard Crook, John Falk, Chris Richardson, Roland Chai, and Mathieu de Heering from Swift. And thank you also your audience for your huge interest and your huge number of questions and comments. I hope you'll all come back when we resume this debate in the early part of the year.
Thank you, Dominic. Thank you.
Future of Finance is taking a break now for Christmas. Our next webinar is on the 12th of January, same time today. So I hope as many of the audience as possible will join us then.
Thank you.
Bye.
Thanks.